Yo guys, Ferocious here. In today's video I'm going to talk about how I use phases of price. Before I move on with the video, I want to say that I do not claim any of these concepts in this video as my own concepts. This is just a video about how I apply phases of price to the market day by day. The topics I'm going to talk about today are key levels I'm using for the phases of price, consolidation, reversal, expansion, retracement, and I will give great examples at the end of the video how I apply this to the real market. First of all, I want to give a small introduction about each phase of price, starting with a consolidation. This is a phase of price where price is ranging between a specific high or low and where is not a lot of movement inside the market. Expansion is the easiest price movement to trade. The market is trending in a certain direction, higher or lower, and with speed and not a lot of pullbacks. Retracement is a phase of price where price makes pullbacks after the expansion phases. Reversal is a phase of price where a relevant level is hit and price starts to trade aggressively away from this level, forming a V-shaped signature at this relevant level. The first phase of price I'm talking about is consolidation. When can we expect a consolidation phase of price? This is after we hit a relevant key level or we had a large expansion. And this is logical since the market cannot expand forever, right? What can we expect after a consolidation? We can expect a new expansion phase or a reversal phase. So how can we engage with consolidations? The first scenario is waiting for the range low to be taken out if we are bullish. We want to see a strong reaction form on the asset we want to trade from this range low and form a reversal signature higher and trade a new expansion phase higher, right? The second option is to wait for an SMT to form at range low if we are bullish. This means we want to see at least one asset inside the triad take the range low and reverse. Then the assets that are not taking the low, for example this asset here, can be traded higher as well if all assets are reversing from this SMT. To qualify a high probability SMT, we require all assets to expand away from this SMT formation. So even the asset that is taking range low should expand higher from the SMT formation, so we can trade the strongest asset to trade higher. The second phase of price I'm going to talk about is reversal. When can we expect a reversal phase of price? This is after we hit a relevant key level and we form a manipulation move at this key level. What to expect after we form a reversal? We can expect a new phase of price, expansion. So how to qualify a high probability reversal? We need a relevant key level. At this key level we want to form a V-shaped signature. Like we see here, we see price going down, hitting the key level, we see it trade a little bit higher, take the range low one more time, and with speed we form our reversal and continuation signature higher. This is marking a V-shaped signature. The second option to trade a reversal is basically almost the same. We are trading down, hitting a relevant key level. We take a little bit time at this key level. We form a SMT instead of a range low purge here. So we have a SMT into a continuation. And again, how do we qualify this as a high probability SMT? We want to see the other assets trade higher after we form this SMT formation as well to trade a new phase of price expansion. The third phase of price I'm going to talk about is expansion. We can get an expansion after we had a consolidation or a retracement. And what can we expect after a expansion? We can expect a retracement, a consolidation, or a reversal in price. Expansion is really important to understand because there can happen like three things after we get an expansion. And this is the main thing I'm using in my trading. So stay tuned for the end of the video where I go over the examples of how to apply this in the real market. So the signatures we want to see in expansion phase of price are shallow moves against the expansion we want to trade. In this example we want to trade the expansion higher and we want to see price finding support at key levels we use for intraday price action such as fair value gaps and order blocks. So you can see prices expanding higher. We form a shallow retracement, finding support in our fair value gaps and making closures above these order block candles to trade a new expansion higher, and we repeat the process until we meet our key level. We can use previous candles range, so we measure range low to range high, and if the next candle is going to expand, it should stay above 50% level of previous candles range, and it should not make a large wick at the bottom in this case. In this case, we can see price forming a small bottom wick, and we stay above previous candles range, and this qualifies to be the next candle, this candle to be an expansion candle. The last phase of price I'm going to talk about before we go into the examples is retracement. We can expect a retracement to form after we hit a key level or after we hit a expansion phase of price. What can we expect after a retracement? We can expect a new phase of price expansion. After price makes such a large range, price can most likely form a smaller range, heading into a retracement phase of price. If we are bullish, the expansion should be fast and large, as we can see here, and the retracement should be slow and shallow to qualify a new phase of price after the retracement for an expansion phase. After we hit a relevant level, we can expect a new phase of price. One of them is retracement. As you can see on the right picture here, we hit a relevant level. We form a shallow retracement with a continuation signature for higher prices. This is one thing I use a lot to still find trades after we hit a relevant key level. So now I will go over some examples of how I use the phase of price logic myself in the market. First example is NQ. We can see we formed a higher time frame reversal here, but that doesn't really matter since I want to focus only on this piece of price action. As we see 6 a.m. approach this relevant high. Like I said, we use swing highs, swing lows, or previous candle highs and lows. So this is a relevant swing. The next swing is this one. So price is failing to reverse from this level. So we either going to consolidate here or we retrace and form a new expansion phase of price, right? So if you are approaching that relevant level, we can look for one of the signatures. As we can see, price is in the first place hitting the key level here. For us to trade shorts, we want to see us trade aggressive down, forming a CISD and see continuation lower, right? But what do we form here? In the first place, we form a fair value gap, like this. So what can we expect after we form a fair value gap and we are not trading aggressive away from this these highs here, those relative equal highs? We can expect a continuation into the new high here. So we are not shooting for home runs, but we can expect, if we are failing to reverse from this high here, we can expect a new phase, either a consolidation or a retracement into a new expansion phase, right? And what do we get here? We get a retracement into the fair value gap, and we form a continuation signature by trading away out this gap, and we can trade a continuation here. So this is the retracement into a new phase of price expansion. But what could also have happened here? We could have still approached the high here. We can form some sort of consolidation here. Then we take range low, and we can still look for an expansion, right? To take the range lows. Or we form a consolidation and trade away higher, since we form a SMT at these lows to trade the expansion higher. So in this case, we had our retracement into a new expansion, but we could have also consolidated into a new expansion higher, since we are failing to reverse from this relevant high, intraday high on the 4-hour. So now let's go over the second example. This is basically the same example, same logic I applied here. We have those relative equal highs on the 4-hour. We are forming an internal to external potential move, but we are trading and approaching this relevant high. So then we are going to monitor how we are reacting to the high. like I said, are we reversing? So in the first place, by this candle, it's a little bit weaker than the previous example, but we still do not trade aggressive down, form the change here for continuation lower, right? We still form a small move down and we form a continuation signature here, like I explained in the slides. So we have again, we approach these equal highs here. We can see price retrace a little bit, shallow retracement, not deep, and we form a continuation signature out of this gap. So once again, this is a retracement phase into a new expansion phase where you could have traded this candle higher to the new target, like we had here, to this new target. If we are not reversing from this high, we go to the next highs. It's as simple as that. So what could have happened too here? Instead of retracing into a new phase expansion, we could have consolidated a bit, take range low, and then expand higher by taking the lows and expanding higher. Or we could have consolidated and expanded away from this consolidation by creating a valid SMT throughout the triad. So this example is basically the same as the first example here. So now let's go over to the third example. It will all look the same. So I basically look for this logic every day. Remove this one here. So again, we have two highs here. We have a relevant high here to the left, and we have this high here. So we can see price approach this high. And what are we doing? We are expanding through it. We are not reversing, not aggressive reversing down. So what can we look for? We can look for a consolidation into taking the range low into an expansion, or we can look for a consolidation into expansion by creating an SMT, or we can look for a shallow retracement into a new expansion phase. So what do we get here? We get our fair value gap again, and we get our CISD out of it. You could have traded something like this. Once we closed above, you can put your stop loss in this gap here, and you could have still squeezed out something like 2R, I think. Yeah, you could have squeezed out 2R trading into this high here. So once again, we are monitoring how we react to relevant 4-hour daily highs, weekly highs. It's all fractal. In this case, we had a 4-hour high. How are we reacting from this this level, right? So that's basically the third example. So now let's go over to the last example of this video. This one is started on the daily. This is previous daily candle, qualifying as a expansion candle. We are closing near its high. We expanded after taking this low. We are failing to trade away from this high, so we can look at this high. We can form a new phase of price. This is previous candle's range. So the new daily candle should not trade anywhere near to this 50% level, and we should not form a large wick at the bottom, and we trade an expansion phase, right? So here we can look for a new expansion, a new phase at this high. So what's going to happen here? We had a daily high. What is the 4-hour doing? The 4-hour is more in a retracement phase, since we are not aggressively trading away from this high. So we are retracing to, for example, this fair value gap. So we have a retracement. On the daily, we are still forming that small bottom wick, qualifying for an expansion candle. We are still in premium of previous day range here, as you can see. So we have our daily high in a new phase of price. We can look for a retracement into a continuation. So again, we had our daily into 4-hour. Now we have our 4-hour into, for example, 5-minute here. Or I think I traded a 3-minute here. So we have our 4-hour high. What is price doing here? Y'all can see we are aggressively trading away from the fair value gap, forming a reversal signature. We have our V-shape here, V-shape signature as a reversal. So what are we doing at this high? Are we approaching the high and trading aggressive away from it, forming a reversal? Or are we going to consolidate into a SMT going higher? Or are we going to consolidate taking the low, range low, and then going higher? Or do we form once again this fair value gap, a continuation signature? So we approach the high, we retrace, and we form our continuation, right? So again, I traded this order block here. So I was monitoring this high, we traded to the high, we retraced, and we formed a continuation and traded the continuation here for like 2.5 R to here. So that was a good trade. So to make a small summary of this video, the main thing I'm using is the new phase of price around those highs and lows. I want to see what we are doing at the high. Are we reversing, retracing, consolidating, to qualify for still a trade after we hit a relevant high? So a lot of people will close charts once we hit the high, but we can still look for continuations if we are not reversing from this high. If we form one of the continuation signatures, like I said, consolidation SMT or consolidation range low or retracement into continuation. So this was basically the end of the video. I hope you all appreciated the video and you guys learned something from the video, how I approach the phase of price. So please leave a like and subscribe since I'm already working on the next video. Peace.